Damien, how you doing today?
I'm doing awesome. Thank you for asking.
Okay, good. And Greg, doing all right?
Doing great. Thank you, Ken.
And Hamad.
Yep, doing very good. Enjoying Sunday.
Good. Yeah, we got a bunch of soccer this afternoon to get to, and our hometown pro team just was so bad. But my youth soccer kids were so good that I'll take that trade all day. You know, I even had a bunch of little guys on the other team that I was playing that have been to my academy, so it was really just like a friendly scrimmage, and it was fun to see them enjoying the match. Okay, so Hamad, first one. This one's really important. How do we know when to use the 3 minute chart and when to focus on the longer term chart for 30 minutes? So I'm going to turn that around and say, what is it that you're trying to do? Before you start looking at the dashboard, you should know what it is that you're trying to do. So if I'm using 3 minute charts, it's because they have, in relationship to the 30-minute chart, a different position, if I can say it that way. But the first thing I'm going to say is, look, there's actually no difference between the 3 minute chart and the 30-minute chart in terms of what we're looking at. We're still looking at the same framework. We have the same indicators. We have the same interpretation. What price movement means inside there is identical. And this is true for any time frame that we're looking at except for the daily. And that's because the daily has a gap, and because it has so much leverage, that there's extra pressure on price, and which means there's extra pressure on decision making. All right. So that means that in the last 30 minutes of the day, maybe even the last hour, there's going to be something that's not present on any other time frame. All right. The fact that we're doing intraday trading and it's in the last hour, and a considerable number of people are using leverage intraday that have to get out of positions, that makes the last hour, let's say it that way, the last hour of the day really important and different. So during that trading day, if it opens here and it closes there, we might say that first 10 minutes is weird because it's clear in the deck, and really the first 30 minutes has unusual behavior. And I'm going to say the last 30 minutes and maybe the last 60 minutes has unusual behavior. Not so much the 60, because the guys that are using large leverage intraday are accustomed to making decisions in short periods of time and pushing it right to the minute. Like there was a long time before ETFs came around that the Ridex funds was a family of mutual funds that was designed specifically for day trading. And so they encouraged behavior, but because they were a mutual fund, they had to close trading in the Ridex funds 15 minutes before the close so that they could settle up and they could get one single price for the end of the day. Well, the difference between a Ridex mutual fund with the S&P 500 and the S&P futures or the SPY exchange traded fund, there was a lot of trading going on in the liquid instruments in the last 15 minutes because they knew that the Ridex guys had to make their moves. Everybody had to get out of their position, whatever they're going to do, get in or get out. So that left 15 minutes for people that were trading more liquid instruments to be able to front run them and game them. So just in a 15-minute difference, there can be shenanigans between day traders using lots of leverage, and longer term traders that have a lot more deliberation. So that's really the only weird routine time frame that there is. Now you might see other specials that are in that. You might say, hey, what about prior to earnings? Yeah. If I'm thinking about swing trading now, every quarter I got to start thinking about, well, what about the earnings? What do I want to do with that? Is there a dividend play or something I got to do? But generally speaking, what we can now think of as the day trading, which you're thinking about because you're talking about 3 minutes versus 30 minutes. What I would say is that if you're using 3 minutes, you're really a day trader primarily. And if you're a 30-minute trader, you are primarily a hybrid trader, meaning that you are comfortable with the occasional move to 3 minutes to fine-tune an entry or an exit. Or you're using the 30 minutes because you're really looking at how to optimize against daily charts as a swing trader. So if you're a 30-minute trader, you could be one of three kinds of traders. You could be a 30-minute trader, and I'm just staying there because that's my area of specialty, and I notice the 3 minutes, and I notice the daily, but I'm really just executing on 30-minute trades. So that's one guy. Let's call him a pure 30-minute trader. Then there's a hybrid trader for swing who says, I am going to deliberately use the 30-minute chart to front run swing positions, which I hope will grow up to be day chart. You know, the daily chart, I can just adjust it once a day and not monkey around with it, like I'm trying to do with McDonald's. Or I am comfortable with these longer term daily trades, you know, on my swing trade, but I notice that it's starting to approach an exit point on the daily, and now I'm going to dial down to the 30 minutes just to fine tune that a little bit more. So now I have now defined the relationship between the 30-minute and the daily as a function of what kind of a trader am I and what is it that I'm trying to do. Well, that's the same issue that I have excuse me, when I look at the 30-minute or the 3-minute. So what the 3-minute does is give me the ability to be a pure day trader, because I have a lot of decision points. I get a lot of information during the day. But I can use the 30-minute chart to do two things. I could inform the 3-minute chart of, like, when am I coming into a decision point? So let's take an example. The 30-minute chart on the RL10 is looking like this, and I notice that it's coming into something I've identified as a resistance zone. And I see it starting to slow down. It has gone from this pure upward movement till, you know, it's starting to slow down. And I decide, you know, I have, on my 30-minute chart, I have to get out here. So now my risk box, my decision box, is now this on a 30-minute chart. Now if I dial down to a 3-minute, the only reason I would do that is if I said, look, I'm going to get out here anyway. Maybe there's a sensible move where I can get an even better exit. And for some reason, rather than just taking the exit now, well, if that was your thought, you're trying to slice that salami so closely. Well, why don't I just take that exit? Okay. Oh, I know why. It is because fear of missing out. Fear of missing out says, what if I get out and this thing immediately goes? So I want to give it a little wiggle room. That's the mental chatter that's going on inside. Now, I understand that. You know, the reason to wait is because I know if I just, well, what if I just re-enter, Ken? Why don't I just exit and then re-enter? Because this might be such a tight box that my signal to enter is here, And then because that might be a burst move north, I get a bad fill and I only get in here. And now I've given up this much. So that's why I want to stick around. Okay, that's a 2R battle drill specifically. So you need to listen to that 2R battle drill video, that little 10-minute lesson, one time a day for the next 30 days, just to be clear. Now, I decide after all that what I want to do is respect my initial stop here on the 30-minute. I don't want to exit yet because I think this is only leg 1, and this could very easily be leg 2 and leg 3. So I want to give it a chance to just go so that I can benefit from a burst move. So here's something I'll do. Go ahead and put, if my mechanical entry to get back in was there, before I exit, I put that order in as a limit. If it goes through there, I'm in. And that means I either got out and then got back in with one position, or it never chased me out and I added a second position where I would have wanted to re-enter anyway. If I do that, it's only because I'm able to look at this risk box in purple and decide that there's 2 units of reward to the upside, which justifies the re-entry here. If there is not a justifiable 2R entry, then instead of doing all this, I should just take that exit now. Be done with it. Move on to the next thing. Save all of that mental energy. But if there is a 2R available to the upside, and I want to fine-tune this exit, now I can come down to the 3-minute chart, and now I can set that up and say the price on 3 minutes, the RL10 on 3 minutes now, remember this thing was going up strong and then starting to slow down. Now this thing looks like this. And now what I notice on the 3-minute, maybe, is this. I have some kind of decision point on the 3-minute developing. And now I know that thing is going to just go one way or the other hard. But what I notice is that I've got rising lows and declining highs, if I can say, lower highs. So this thing is in a zero state now, and it's likely to make a big move in either direction. And now when I notice on my 30-minute chart, my exit was way down here, now there's a reason to adjust my stop in a way that maybe I want to just go to the last, maybe I go to this one. I'll go to that one and say, that's the one that I really want to raise my stop to. And now this thing might go fake one and go 2, and I'm still in. But what I really just did was preserve this capital here. And then maybe I noticed that my re-entry move, which was up here on the 30-minute, maybe I noticed that is right here. So all I'm doing now, what I just did was I said, let me go down to the 30-minute to fine-tune this exit, to understand the 2R battle drill on the lower time frame, confirm that these are my actionable moments. This is when I'm going to add a second position. This is when I must be out of the position no matter what. But now, on that basis, because of this pattern on the 3-minute, I now realize that I'm actually trying to stay in so that I can get these 2 pieces against that unit of risk. Now I get 2-to-1 on the... So that makes perfect sense. I could imagine how I could look at that entire trade frame, even if I didn't have any money in there that I was trying to preserve, and I would not mind buying this position right here. I could just buy this right now because I have 1 unit of risk, and I have 2 units of reward. So that trade is justified, and I know that I'm going to get long here anyway, and I know that I'm going to get short here anyway. So on its very own merits, this is a reason to be in the trade because I can see 2 to 1 right now. But if it was so close that I couldn't see 2 to 1, I would just say, instead of all that pain and suffering I just went through, I could just take the exit and then just be comfortable with the fact that I saved all that energy and I could go long or I could go short depending on the next move. Now, because I'm looking at 3-minute and 30-minute, I now have to come down to the daily trade and say, how close am I to this dead zone over here where things are going to go crazy? If I'm in this position here intraday where I've got plenty of time for normal moves to unfold based on the statistics of the previous move, then I'm okay. But if I'm already getting into the exit zone anyway, I just take it and wait for tomorrow or something like that. So I say all that simply to say, when should I use the 3-minute chart and when should I go to the 30-minute chart is a function of who are you as a trader, what is it you're trying to do, why are you in that trade at all, because it's justified. I just did some rapid trade framing. Now let me talk about, this was when I started as the 30-minute and I decided to go to the 3-minute to refine that technique. I just made the case, well, I'm primarily a 30-minute trader, and now I'm looking at the 3-minute trade just to refine my technique. The other normal place that you would see this is going in the other direction, and that is, what if I'm primarily a 3-minute trader, and now I'm thinking about this thing as a longer-term position. Maybe this could grow up and be a swing trade. So here I am early in the day, and I'm over here on 3-minute charts, and I set up my frame. And I got my little minimum and let's see, where's my price? Yeah. So here's where it opened, and now price came down here, and it held support, and it's starting to go up, and I identify that as a SSC. Maybe that's an SSC according to all my rules. Check or hold. So what I do is I say, look, here's my risk box, probably. And I know that if that was the low of the day, I'm going to go large with a collapsing dragon anyhow. So I know what to do if it falls out of my box. And now I have this nice little manageable risk box here. And I decided, yeah, I'm going to go here with my mechanical entry. And now I've got 2 units of reward to the upside. I'm good. Maybe this up here was the high of the day or so. I don't know. Maybe that was the RL 270. This was the reasonable profit target. Maybe the range stat is something like this. And so if this thing really goes well, it could go that far today. Love it. But I saw the last hump of the dragon, or the last time the RL30 moved, I just decided it could reasonably get to there, but it might also reasonably fail. And that might be 1/3 of the way to a range stat move. Check? So I decide, I just hold my nose, and I make the entry, and then I'm thinking about, here's my standard, this is my standard success bar. I have, I aim for 2, so here's 1, and maybe my average win is 0.7. So what I'm really doing is I'm aiming for 2, but I end up getting 0.7 on average. That also means that sometimes this thing will go past 2 and beyond. And then a lot of times that thing just fails fast. And maybe my average loss is 0.3. That would be awesome. And here's my -1. So now I have that template of what my normal trades look like. I might say that in this kind of a setup, maybe a win of 1R is like average plus 1 standard deviation. So I should know what my standard deviation of my trades, of my winning trades are, so that I know what the upper limit of normal is. So if I know all of this, which I can only know if I'm using a standard set of rules and I'm tracking my performance and how does this system perform. Now let's suppose I'm primarily a 3-minute trader and I set up this trade frame, and now suddenly this thing, well, let me put it in black. There we go. So this thing starts going. It doesn't get me out. And now it's starting to go. And now here I am. I'm only 2 hours into the day. I'm far away from this exit zone. So I've got 1 or 2 or 3 hours that I am comfortable that I'm in this next leg up, that I have left behind my original tactical trade. That's in the bank. That's my money. And what I'm going to do now is I'm just going to say, whatever my initial risk was, I am going to preserve all of this stuff. That is all my money. Now, in this period of time here, as this thing is chugging north, maybe I don't want to watch that every 3 minutes and suffer. So I will now just maybe turn that into a 30-minute trade, let it trade forward for about 3 hours until it starts approaching the dead zone, and then make a decision if I want to hold it overnight or not. If I do, it's probably because I looked, maybe I even went out and looked at the daily chart and see, where is this thing inside its 10-day range? Where is this thing inside its 3-day range? Or how does it look on the 30 minutes? Is it clear of the last resistance zone and it's free and running? Now what I've done is I've taken a primarily 3-minute trade, and because it performed abnormally well, and there's reasons to believe that the next higher time frame is going to help me out, I can now shift to a 30-minute chart and trade it that way. So I say all that just to say, when should I use the 3-minute chart and when on the 30? In this lineup between the 3 and the 30, and I'm going to just put in parentheses the daily trade because we're concerned about that. Sometimes I'm a 30-minute guy coming to the 3-minute to fine-tune because of a specific decision I want to make. And sometimes I'm a 3-minute guy going to the 30, and I'm going to try to grow it into a longer-term trade because of the evidence that I see or the trade frame that I can make on the 30 and maybe even informed by the daily. Once you get good at that, you can make a snap decision on that in 10 seconds. Because I want you to draw a picture of what is it that would convince you to stay. So draw that picture. Now you have a template. And when you do a quick look, does that look like my template? If yes, do it. And then do it at 1/5 or 1/10 of the position size as we discussed last week. Otherwise, thought about it, wasn't there, and I'm just happy to be a 3-minute trader. The same thing that I just said, you could now say as a primarily day chart trader who occasionally dips into the 30-minute and occasionally dips to the 3-day to get the longer-term growth. exactly the same thing, only you don't even have to worry about the gap, because any stop that you have for overnight holding on a day chart is already incorporating the information about the normal size of the gap. You've already covered that. You don't even care about that. Check or hold? All right, that was gold right there. Yeah,
Just a quick one. Can I try to rephrase that to see if I got what you said?
yeah.
So basically, this is what I understood. First of all, I need to figure out what kind of a trader I am. Do I want to be an intraday trader? Do I want to be a longer term trader, right?
Yep.
And then once I kind of identified that, let's say if I'm a short-term trader, intraday trader, I would look at the 3-minute chart, basically frame my trades 2-to-1 risk reward. And as the trade goes in my direction, I make, let's say, more than 2R, protect at least 2R of profits, and then look at it in the 30-minute charts to see if there's potential to make more.
Yeah, and I'm using the round number of, like, if your average win was 0.7 and you're holding 2R, you already are beyond the level that you thought you were aiming for. So this is, by definition, an abnormal trade. Maybe that if you spend about 20% of your time with that, that means about 1 out of every 5 or about 1 out of every 10 trade even performs well enough to go look. It's kind of already past that boundary, you know. Now, when you do your trade framing out of the market, and you said, here's my chart and here's my 2R, you're already kind of looking at where those higher moves are, so you know if this thing is already a candidate for that. So it won't come as a complete surprise to you. Yeah. So, yeah, you're on it. All right, next one. Divergence between price and MACD 4 seasons. You noticed prices were trending up, but the MACD seasons were falling, and it really wasn't, it wasn't aligned. So this is like, if you think about how we interpret MACD anyway, conceptually it's the same thing. There's a season when winter is happening. In a winter, both of these things are just getting crushed. That's when you want, that is your maximum time to be short and killing it. And then the other time when it's absolutely clear is in the summer. And that's when prices are trending up and the MACD is over the 0 line and that thing is going. So when that's in the summer, it's clear that you want to be long. No hesitation. So what that means now is I am always going to have a divergence in the spring and in the fall. Mathematically, you're always going to see that. Because in the spring, what used to be price that was bad enough for the winter started to improve enough where it's going up. And you see some, what are you going to see? SSCs, some beginning Kata 2s. You're going to see eventually an owl. All of those things happen most of the time in the spring because it took a winter to make it horrible enough that those things are now meeting their criteria. So if you want to trade that way, 100% of the time, you're going to find yourself suffering because of that divergence. If you have reduced this to a set of rules that you know what it is you want to do, and this is what you want to do, and now change my mind. Put a tight risk box on with a minimum manageable risk box. See that you have 2-to-1 to the upside. Go for it and get out of it if it fails. Lock it in if it works. And now, these are not failing trades. This is just me walking in the rain. And when you walk in the rain, you get wet. But you get there before the other guys, and you have buckets of water that you carried. So you just get used to the fact that I'm always going to be wondering what in the heck is going on. Why is there there's a divergence? Because this setup puts us into that position all the time. So do this with your initial battle drill. Do not believe in the trade. Be ready to go with the collapsing dragon, because the primary trend we remember was the winter. So you love getting into an SSC that fails, taking a micro loss so that you can be in the trade you want to be in. Then you get to feel that you were wrong and lost a little bit of money, but you're into the position you want. But sometimes it works, and it works often enough that you can make that positive expectancy, as long as you don't suffer with the exit. All you got to be able to do is take it and then re-enter, take it and re-enter, keep shooting, keep shooting, keep shooting. I didn't expect it to work. I just keep shooting, keep shooting. Sometimes you get cards. Sometimes you get a pair of aces. And there you go. So you just... Now, the other place that happens is in the fall. Only now, the primary trend that everybody can see is the bulls are ascendant. And now you have bullish price action, and you have bullish seasonal action. That's every Kata 2 in the world forever and ever. Amen. Now, I think Rad asked me, hey, why did you do that with McDonald's? Your trade was different in McDonald's than almost all of the other ones. Yeah. McDonald's was the strongest symbol in the S&P 500. It is above its all-time high and killing it everywhere. So that's 1 in 1,000, 1 to 500 if I'm honest. So if I was ever going to believe in the long side and let it play with market's money, it's going to be McDonald's. But you'll notice that the decisions I was making to stay longer than I usually do were because I already had market's money in hand. I'm going to just leap ahead because we're at that point in the Q&A that I want to make this point. So he quite rightly says, what are you doing? The last 100 times we watched you trading, Ken, you would have normally gotten out either here or certainly here in order to preserve this much money against that much risk on 2 positions. Yeah, you're right. And normally, usually, always I do that. But this is the 1 in 100 where it's McDonald's, and his chart was so far off it was off the chart, all-time high, bullish young bull. Imagine what a young bull after 18 months of bear means to portfolio managers. Oh, they are suffering, and they need to get on some winners. And now, if they look around and see this is an early bull, it just crossed the 200-day moving average, there's going to be a lot of discretionary money coming in. Where is that money going to go to? Oh, how about the safest stock in the world right now? McDonald's and probably Coca-Cola. McDonald's and Coke. Only McDonald's had a far better chart. So I didn't get out here. But if I also come down here and look, I'm above the 0 line, testing the 0 line, and this was fall, out of the Red River, spring, going through the Red River, fall, summer. I'm sorry, this is summer. This is fall, summer. Summer, fall, summer. If there was ever a chart I'm willing to give the benefit of the doubt to, especially with markets money, it's this one. Now, what if I didn't do that? What if I said, take that exit? Here's where I get in the very next day. Same difference. Over the long run, is this a perfectly good one? Yeah, because then I still get out here, and then I wait and Kata 2, and I'm still back in. The actual difference between those two is not that great. But I was willing to give McDonald's the benefit of the doubt at the close, because look at the gaps up that it's been given. And it happened to be lucky that that happened. So 1 out of 100. Do you have to master that? No, you do not. The only reason I can even do that is because I already have money in hand in this system and strategy. If you look back at February, we're up 300R in February. And I'm getting ready. I was going to total up March and April this weekend and just got lazy. But both of those months may not have been as good as February, but they're over 200R. Both of them. And in that whole time frame, the only time you've ever seen me do that is once with Microsoft. McDonald. I keep saying Microsoft because I want to do the same thing with Microsoft, because it's winning the AI wars. Now, if you listen to the Friday night, we had a position in here where I said, hey, what am I going to do in that location? And everybody who's been conditioned to watching me trade, they were either exiting or keeping a half or keeping a third, and I added the same 3 positions. I added 3 more. Yeah, don't ever do that. But I did that because I'm up this much. This thing is up +7 just from those 3 trades. So I'm betting that if this thing gaps down, it could have a gap down of twice the size of my risk box, and I'm still positive on the trade. But if it gaps up in my favor on 6 positions, I'm going to be extremely satisfied. I'm willing to take that risk because I have a buffer of market's money, and now this is an advanced strategy. To understand those ideas, you need to buy the $79 report from VTI on Dr. Tharp's money management strategies, because he has 81 different strategies for how to do money management to start leveraging market's money when you have a positive expectancy system that you know intimately. That's advanced trading. But that's built on a foundations of our foundations course. Oh man, that was drawing things inside PowerPoint. So now I got to figure out how to get out of how to erase those drawings. Oh, there we go. Nice. All right, back to Hamad. So that's my answer to number 2. The divergence, by definition, is going to have you there in the spring and in the fall, and that's why you've got to practice that. Improving your symbol selection. Here's a quick look. This was from Friday's report. This is just the tactical symbols from this from the swing trade. So this is a subset of my larger tactical set. In this one, I have sorted it by percent changed. In this one, I have sorted it by the swing trade reward to risk. Now, here's what I noticed. Tesla and Alcoa were smashingly good yesterday, and they still have 3-to-1 on the swing trade reward to risk. So if I looked at that as Friday, those things had really good moves, +2%. And then just based on the daily move, they still have 3-to-1 back to the 10-day high, which means that the day before yesterday, their reward to risk was even better because it didn't have the benefit of a 2% gain. They were down here. And yet they opened here and they had a 2% gain. So now as I look at as I look at Monday's trade, I might decide which of the highest percentage movers also have the highest remaining risk to reward and prioritize those. Why would I do that? Because I have 1 day of evidence that the buyers dominated and there's still reward to risk available. AI, it was up 1.3%, but it's 4.5 to 1. Awesome. Cliff is not bad, 1.38 and 4.2 remaining. But IP, not so good. Not a huge day. But it has 3.7 to 1. But I'd rather have both of those things true, right? And U.S. Steel, it was down 3.6%, and now it is 3.5 to 1 to the upside. So U.S. Steel looks like this. It was down bad, I mean really bad, but it now has 3.5 to 1 back to the 10-day high. But I got no evidence that people are buying that one. So if I had to choose something between 3.5 to 1 and one of them was down 3.5%, and Alcoa is 3.2 to 1, but he was up 2.4, all other things being equal, I'm going to be, if I looked at Alcoa versus U.S. Steel, which I will, because they are both metals, I put them on my chart and I'm ready to trade the first one that moves out of his box because they are both abnormal. They have abnormally large reward to risk and they have abnormally large 1 day moves. One of them just happened to be positive. One of them happened to be negative. Hey, what if Alcoa, or what if U.S. Steel started to fail and Alcoa started to fail? Which one am I going to believe? U.S. Steel? Because it's already building on momentum of something that was horrible. Let me tell you something. You've seen me pulling a lot of money out of the markets just with those signals, those symbols on a swing trade, on 30-minute charts. So now if I wanted to do that a lot, I could go down and be a 3-minute trader. Guess what I do most of the time? That. I've already got a dozen things ready to look at. And then I also have my favorites that I'm always ready to start with a 3-minute. I like to use the first 30 minutes to get well started, just to get my feet wet, try to make some money with the OR3s. And then after 30 minutes into the market, I should kind of shift to what's going on the 30s. How are we looking? And now I'm actually doing a blend. I am both a 3-minute and a 30-minute. So I am finding that perfect balance point. Now that's hard to do. The easier way to get into that position is start with 30 and occasionally be a 3, or start with a 3 and occasionally be a 30, and then the balance point is one where I'm equally comfortable starting the day with the 3s, shifting to the 30s, doing that for a while, going to the 3s when it's, and then in the last hour, going back kind of strictly to the 3s to make sure I can fine-tune my exit. So that's one way to answer that question. Remember that the chop is the normal condition. I feel like when you say you're being chopped, you're treating that as a negative and a pain level. So you just got to make that the expected case. That's what I expected, so it doesn't have any negative emotional valence. It's not draining your emotional bank. It's just, hey, when you go play poker and you only play 30% of the hands, most of the time you're being chopped. You lose the ante. That's what you do. You know, if you go to the poker table and you muck 3 hands in a row because you didn't get cards, and then your self-talk is, I wonder why I can't get cards. What's wrong with me? Why are the guys? You're never going to succeed in poker. Because nobody cares enough about you that much that they're trying to, cheat you with giving you bad cards. That's just the law of large numbers. So you got to get past that. Don't mess with these yet. Hold that thought. If you were only going to use one, I would use the fail stat, which is from the open, how far does this thing routinely go on average before it starts moving to find the high of the day? That's the only one I would mess with for the next year if I was you. Here's why I say that. This is what you look for. If yesterday's candle looked like this, and you saw a low of the day, and you saw that it closed here, and then you saw when it opened, imagine this. Now it opens. Where's my little let's say it opened right here, and it sold off to here, and you knew that this was the fail stat. You knew that that was the average distance to low of the day from the open. What a bad way to say that. That's the average distance from the open to what will turn out to be the low of the day. That's what I was trying to say. Okay? And if you knew that that was there, and you saw a gap up, and you knew that that was a large gap, that you knew today was going to be a large move day, and it opens here, and it sells off quickly, and then starts going up before it even gets to the average loss, and you knew that your minimum manageable risk box was like this, could you just take that trade knowing that your range stat, let me draw it in orange, that your range stat was this, it's 10 times the size of that, so you got 9 of those to the upside? Could you take that entry? Yes, you could. Should you take that entry? Yes, you should. How many times a day should you take that entry? All of them. Every day, forever and ever. And if you had 3 symbols that you specialized in as your favorites, that no matter what else happens, no matter what happens from the day before, you are always ready to trade those if you see that. Yeah, do that. So use the gap stat to understand what a big gap means. Use the fail stat to understand, is it turning around quickly in the first 20 minutes and starting to go? And is the rest of the market going up? Dude, you crush that. Crush that. Now, on this one, how to use the daily and weekly reports to find symbols to focus on. Go to Patreon. Go to the archive where I post the nightly strategy podcasts. And the archive is below there. It has all the dailies. Then there, just above that is the Trader's Mind series. And about a month ago, I went through a 1-hour explanation of every indicator and section on the daily report and a 2-hour explanation of the weekly, which answers that question. And then I sent you last week that worksheet, which had a bunch of sections in it. And it had, this was my favorite swing patterns over here. So I read the report and I make notes of which ones are setting up on the swing. And over here I had like frog champions and what are they doing. And over here I had, this is a list of my continuation patterns. So all I do is I take that report and I find the 3 sources of new ideas. I always am ready to trade frog champions. I always am ready to trade swing patterns from the mechanical systems. I'm always ready to continue trades that are already open and that I'm emotionally committed to. And then there was some stuff in here about market and sector conditions and notes, and that is how I take all the crap from the daily report and turn that into a production list, and then I go prepare. So that's if you have a lot more than just what I've already given. You need more stuff. That's a good habit to get into. So that. Now, red. This turned out to be the same question as Hamad's with the, hey, what's the deal when price and PSAR are diverging? It's because, again, you're in the spring and the fall, and so you must be tentative with small bites. And if they work, then you start adding pieces. And the same thing on this one, in the fall. And then you look for winter, spring, winter, because that one takes precedence, and then you crush it to the short side. And in the fall, you already had summer, fall. If you get summer, you crush that because it's going to continue that leg up. McDonald's, let's see, where was the, come on, Kenneth, get your pen, oh, I bumped the tablet and the pen came out. So the McDonald's one, again, that's a 1 in 100. It's probably closer to 1 in 500 that you've ever seen me do that. Or the real question was this, and the reason I gave you was because it was in summer, fall, summer, and I had a buffer of markets money. But later, when it did not follow through very well, it gave me one, it gave me another, and then right at the end, it gave me a lower high. That was enough. I was already feeling guilty for that. So, okay, you gave it a chance. Out. But then when it found its Kata 2 level, I'm right back in. And then I put the double up on those 3 positions for the reasons that I explained. Jumping into the trade. First of all, we're never late. We only had decisions not to enter a good enough pattern. If I see an SSC and it does this, and I'm supposed to enter here in that rule set, the only way I can enter that is time, will, pattern, and money. If it's only 30 minutes into the day, I have time. I have the pattern, it's the SSC. I have the money available. What I didn't have was the will. If I don't enter that, then I just say, I wasn't ready to enter it, So there it goes. If I get in on a COTA 2 later, it's because the COTA 2 is its own valid pattern, and I have time, will, pattern, and money. I'm not entering this knowing that I was late, because if I say that I am late, it's because you still have emotional connection to the trade not taken. You didn't leave that alone. You got to get to the zero state and said, that was just a trade I didn't take. And it has no power here. It has no influence to come into the decision to take a COTA 2 or not. None. Because I got to the zero state and I cleared my emotional bank account so that I could just look at the COTA 2 all by itself. Otherwise, this COTA 2 decision is carrying all the emotional baggage of this one and all of the other trades that have ganged up on me, and now I got all those emotions in my head when I'm just trying to decide to take the COTA 2 or not. Screw that. You got to get to the emotional zero state before you can even look at the next trade. Now, when I'm in a COTA 2, I don't even know. If I get into this trade, I don't even know. Is it a second position on a trade that I'm already in and it's working? It doesn't matter. This trade pattern was good enough. I have time, will, pattern, and money. That there's still a 2-to-1 just on that trade and that trade alone that justifies taking it. And I have money to put on it and no better ideas, and I have the will to trade it on its own merits, and there's time enough left in the day to do it. So we are never late. If you're in your mind, you hear the monkey saying, hey, I'm late and I got to get in. No, you don't. What you need to do is get to the zero state and wait for the next time around the merry-go-round so that you can be in a proper emotional state to trade with no emotional baggage from the last trade, perfectly balanced in the moment, one with the sword, ready to take the position because you already are in the position. Because when you're truly in the zero state, you just enter. And then your monkey mind catches up and said, oh, I guess I just entered. What do I got to do now? Manage my stop and get to no lose plus dinner for 2. I love to be surprised by my own behavior like that. Oh, I got into that trade? Okay. Get to no lose plus dinner. I don't even care if it was a good decision to get in or not. Once I realize I'm in the trade, it's a visceral shock. And the only thing I have to do is call my fireman and have my fireman get me to no lose plus dinner for 2. And save my bacon once again. Save me from the fire, Mr. Fireman. That's why he's my hero. I've already left the reason why I got in behind. I'll look at that when I do my assessment to determine if I followed my rules and was I good and could I have gotten in earlier, could I gotten in later, evaluate the entry in a dispassionate way after the market is closed. But once I'm in, that is history. I'm worrying about today, this moment. Get to no lose plus dinner for 2, because that's the only thing I have to do. All right, that I think answers all the questions. Great job prepping. I think I give you better answers when you set me up like that, and I get a chance to show you some charts and graphs and think about it for a second or two. Okay, so good job. Let me. I'm gonna take a 3-minute break so that I can get this thing processing, because otherwise it takes me a lot longer to break the big file into 2 pieces. I'll get you both of those, and again, you guys are more than welcome to hang in there. Let's see, Hamad, I'm noticing chat real quick. Scheduled news, the only thing really, Greg, on that is Fed Day, because most of the things I'm trading are really connected to that. And so I just trade the Fed Day a little more carefully. And I make sure that all my swing positions have proper trailing stops, or just get out of it. If I have to spend more than a minute thinking about it, I'll just get out of it and re-enter later. As you specialize in symbols, you may discover that there are some things that respond to other events reliably and large. But that's going to be for you to discover with particular symbols. I really don't mess with it. The only other thing that you might look at, and only for swing trading, is on if you're in the position with the swing and you got an earnings announcement coming up, so that's once a quarter, you better figure that out. The other thing I'll know is if I'm not in the position, I love trading the earnings the day after earnings, because that's going to be a big mover as people get surprised by the previous day's announcement. So the earnings day, gets smashed or runs amok. I like day 2 of that. Okay, so that's everything we got. I think that's everything. Oh, on Forex, I'm not a Forex specialist. I would point you at Dr. Eric Morrison. He and that gang of guys have been doing so good on the Forex that he retired from teaching in our military college. He and I have been partners there for 10 years. He'd been a Forex trader for 20, and he started studying with me, developed his own course, has automated it with robots, has a little community of practice that is automated the hourly charts. And that is really a good place to go if you want to specialize in Forex. Otherwise, what I would say is I don't know enough about Forex announcements to give you an intelligent answer. I just know that I can trade them on 15-minute bars on any day of the week. And that's about how smart I am on Forex. And I look where the 10-day turning points are, too. So to me, the 10-day frame and 15-minute charts is how I do Forex with pairs. And I use Forex futures pairs. And I like the New Zealand U.S. dollar because I like the name of the Kiwi. And I like the Aussie dollar, and I like the Canadian. Because I like those 3 countries. I don't know why, but I just started doing those 3, and they work for me. You ought to watch what Constantine is doing with gold U.S. dollar futures pair, because that's kind of like Forex, and he is murdering it. He's earned his way up to managing a $2 million proprietary trading account just using that. You ought to go into chat room and look for everything Constantine does, if that appeals to you. Okay? All right, that's everything for there. Let me get this exited, and great set of questions, guys. And I do, for the other foundations, guys, I also do one on Thursday. So, you get 2 bites at the apple each week. And thanks for all the setups. You made this one fun. And I'll start it up here in a few minutes.